Underneath every business valuation, every multiple, every rule of thumb, every comparable sale, there's just one core idea. A business is worth the amount of cash that it'll produce in the future. And today, we're going to unpack that through the lens of the income approach. This is part two in my four-part series on how to value a business. In part one, we covered the market approach, the most common method based on what other similar businesses have sold for. If you haven't watched that yet, start there. The link will be in the description. Today, we're covering the income approach, also called a discounted cash flow analysis, or DCF analysis for short. I like this approach because it really reinforces the fundamental principles of business valuation. For those who don't know me, I'm Ed. I'm a business broker and the founder of Sundance Financial. We help small business owners sell their companies all over the US. Now let's get into it. Before we get into the mechanics, let's first talk about why we value businesses the way that we do at all. The core idea behind every valuation method, the market, the income, the asset approach, every single one of them, is simply this. A business is worth the amount of cash it'll produce in the future adjusted for two things. One, the time value of money, and two, the risk that the cash never actually shows up. A dollar earned today is worth a lot more than a dollar earned 5 years from now, and that's for two reasons. The first is that you could take that dollar today and reinvest it. It has its own earnings potential. The second reason is that there's more risk. No one really knows what's going to happen 5 years from now, and so no one knows whether you'll actually receive that dollar when the time comes. The longer the time frame, the less certainty there is. So when we value a business, what we're really doing is estimating the business's future cash income and discounting it back to today. Hence why it's sometimes known as a discounted cash flow analysis. The income approach does this directly. You literally take the cash flows and discount them. The market approach, which we covered in part one, does it a little bit more indirectly. When buyers pay 2.5 times earnings for a landscaping company, they're implicitly making the same calculation about future cash flows, timing, and risk, but using transaction data as a shortcut. Both methods are really just answering the same fundamental questions. The income approach just shows you the underlying math, which is why even though most small businesses will never use this approach, I find that understanding it is really helpful in terms of understanding business valuation. Now let's go back to the landscaping company from part one. The owner's SDE in our example was about $300,000 per year, and the market approach gave us a value of $750,000 for the business. For the income approach, we don't use SDE directly. We use what's called free cash flow. This is the amount of cash that a business generates after adjusting for reinvestment required, but excluding financing payments. Importantly, this differs from SDE in two ways. The first is the owner's salary. SDE typically adds back the owner's salary, whereas free cash flow doesn't. Now, the second is reinvestment. SDE doesn't account for the capital investments that a business needs to make in its assets or its equipment. That's things like trucks, mowers, and power tools, whereas free cash flow does. So if we take the $300,000 in SDE and we assume the owner's salary is $80,000 and capital investments are about $20,000 per annum, we can subtract those from SDE to get free cash flow, which gives us about $200,000 per year. That's our starting point. Now that we have our starting point, we run the process through 3 steps. Step 1 is to project our future cash flows. Let's say that we expect that $200,000 in free cash flow will grow at 5% per year for the next 10 years. Year 1 is $200,000, year 2 grows to $210,000, year 3 to about $220,000, and by year 10, we're at about $310,000. But we're not done. The income approach also includes something called the terminal value, which is what a business could theoretically be sold for at the end of the projection period. In our example, the projection period is 10 years. So let's say that our landscaping owner sells the business at the end of year 10 for $900,000. We would take that $900,000 and add it to the $310,000 of cash generated by the business in year 10 to give us a total of $1.2 million for that year. Step 2 is to pick the discount rate. The discount rate should reflect the underlying risk of the business. A stable business with recurring revenue, multiple customers, and a management team that extends beyond just the owner will get a lower discount rate. A business that depends on one customer, one owner, and operates in a volatile industry might get a higher one. The higher the discount rate, the higher the risk. Now, for small businesses, discount rates will typically land somewhere between 20 and 40%. While there are slightly more technical ways of selecting a discount rate, for our purposes today, let's just go with 30%, the midpoint. Now that we've established a discount rate, step 3 is really to discount each year's cash flows back to today and then add them all up. So here's how discounting actually works. To convert a future dollar into today's terms, you divide that future dollar by 1 plus the discount rate, raised to the power of t, where t is just the number of years from today when the cash is received. So in year 1, the $200,000 received 1 year from now gets divided by 1.3. That's about $154,000 in today's terms. In year 2, the $210,000, which we get about 2 years out, gets divided by 1.3 squared, which is about 1.69. $210,000 divided by 1.69 is $124,000. In year 3, you take the cash flow and divide it by 1.3 cubed, and so on and so forth. Each year, the denominator gets larger, and so the present value of that future cash flow gets smaller. By year 10, that $1.2 million in cash that we generate is actually only worth about $88,000 in today's terms. Now, once we've calculated the present value of all 10 years worth of cash flows, we can simply add those values together to get $770,000. That's the value of the business today based on the income approach. Now, here's the interesting part. The market approach that we went through in part 1 of this series gave us a value of $750,000. The income approach, which we went through in this video, gives us a value of about $770,000. These are pretty similar, and that's not really a coincidence. When assumptions are reasonable, valuation methods tend to converge because all valuation methods are essentially answering the same set of fundamental questions. But watch what happens when I change just one assumption. If I drop the discount rate from 30 to 25%, same business, same growth, same terminal value, the answer jumps to about $920,000 because we're now saying that this business is inherently less risky. If instead I bump the growth rate from 5 to 10% per year, the value changes to about $880,000. So small changes in the assumptions and inputs will drive big changes in the answer. That's the catch with the income approach. So can you really trust the income approach as a small business? The answer is usually no. And that's exactly why most small business sales will rely on the market approach instead. The income approach only really gives you a reliable answer when 3 conditions are met. 1. The business has stable, predictable earnings, at least 5 years of financial history, showing consistent growth and margins. If your last 3 years look wildly different from each other, projecting the next 10 years is going to be tough. 2. There's a clear understanding of the business's reinvestment needs. Free cash flow really depends on knowing exactly what the business needs to reinvest into to keep running. If you don't have a strong grasp of the equipment replacement schedule or your maintenance spend, your projections aren't really going to be reliable. 3, which kind of relates to the first point, but a relatively diverse customer base, or at least a relatively sticky one. If half of your revenue comes from one client and you don't really know if that client's going to stay with you, then predicting 10 years out is going to be really, really difficult. Losing just that one client would cause a 50% swing in your revenue. Now, most small businesses don't check all 3 boxes, which is why for owner-operated companies, the market approach, which is grounded in real transaction data, is far more reliable. The income approach really comes into its own in the lower middle market for businesses doing probably a lot more than $5 million in revenue. That's where there's enough operational history and organizational structure to make these projections more meaningful. So that's it. That's the income approach. In part 3, I'm going to cover the asset approach, which is essentially what your business is worth based on the stuff it owns. It's much simpler than today's video, but most people get its role wrong. Finally, in part 4, I'll cover the valuation method that most business brokers won't talk about, and the one that every serious buyer will actually use. Subscribe to my channel to make sure you don't miss these videos. If this series is helping you, you can do me a favor and hit subscribe. And if you want to talk through what your specific business might be worth and your specific situation, I offer a free, no obligation consultation. The link is in the description. Again, I'm Ed from Sundance Financial, and I'll see you in part 3.